I'm Grant Walker. Welcome to Last Call for Thursday the 7th of May. And I'll be back with Heads Up Friday morning, 10 a.m. To employment, job opportunities in the banking and finance sectors are buoyant, even though New Zealand's unemployment rate remains at 5.8%. The latest numbers from SEEK show the banking and finance industry has exploded in popularity, with job opportunities up by more than 50% in the past year. The data also reveals an almost 160% increase in retail and branch banking roles. SEEK's General Manager Janet Faulding says consumers are still wanting to deal with people at banks, and banks are recognising this. Candidate interest in jobs is also up in the sector, with an almost 60% increase on this time last year. Randstad New Zealand manager Brian Keegan agrees and adds the banking and finance sector is one of the most attractive in New Zealand. He says many UK and American banks have experienced a barrage of criticism lately over their risk and compliance measurements. Mr. Keegan says, I think while that's been taking place, the New Zealand banking sector has continued to do quite well. New Zealand's banking and financial services sector has remained relatively stable throughout the GFC compared to those in other countries. Mr. Keegan says the banking sector has a strong employer and employee brand proposition, and elements such as work-life balance are starting to show. Despite the high levels of job opportunities, the latest numbers from Stats New Zealand reveal the unemployment rate remains sticky on 5.8%. But BNZ senior economist Craig Ebert says the local labour market is reaping the benefits of increased economic confidence. He said New Zealand's job growth has been exceptionally strong for a couple of years. This is continuing by the look of firms' employment intentions, which are as strong as overall business confidence. He says the fact the labour market is buoyant fits with the above-normal growth in consumer spending, relatively high consumer confidence, and the boisterous housing market. Tax news. Moves to reap more tax from offshore-owned banks and other entities are to be unveiled today. NBR Radio understands Inland Revenue is about to release a set of proposals aimed at gathering more non-resident withholding tax from banks and other offshore-owned New Zealand firms. The moves will be badged as part of the global crackdown on profit shifting by multinational firms, dubbed BEPS or BEPS, or base erosion and profit shifting, being pushed hard by the OECD. If implemented, it's understood multi-billion-dollar amounts of bank funding not currently caught by the tax net could be added to the country's tax base. At the same time, changes will push up the cost of bank funding in New Zealand and probably lead to either the banks taking a haircut on their profits or in higher retail interest rates, or most likely a combination of the two. For the New Zealand Tax Authority, this long predates the BEPS issue and has been on the wish list since at least 2008. There are three core concerns identified in a cabinet paper late last year: inadequate coverage of when NRWT is deducted, leakage around the associated person test, and payments to firms operating a New Zealand branch not fully covered by the rules. The Australian-owned banks are in the direct line of the IRD's fire. There are exemptions to NRWT, but one of them under current rules can be claimed by non-resident firms to lend to their New Zealand subsidiaries without needing to pay NRWT or treat the interest as income of the New Zealand branch, provided the parent company operates a branch in New Zealand. Another loophole that looks like being closed allows firms to defer paying the NRWT until interest on loans is actually paid. In some cases, it may be possible to create debt instruments where the terms are such that there is indefinite deferral of the obligation to pay NRWT, officials told ministers late last year.
NBR Radio, Thursday the 7th, I'm John Stewart. In the US, it's becoming increasingly difficult to register a patent. I'm joined by Nathan Smith. So, Nathan, is this a major challenge for people going into the States with their own IP?
It's certainly something they'll need to watch. Over the last 18 months, there's been a bit of a shake-up in the IP sector, especially in the States, but also in Europe and as well. And China's coming on board with their new ones. But specifically in the States, something known as the Inter-Party Review Process, which began in 2012, but has really been picking up in the last little while, is being termed the Patent Death Squad. Because a lot of these patents that are coming in front of the Supreme Court and also this board are being thrown out as not viable or not reflecting reality. So a lot of money that has been spent on patents has simply been, appears to have been wasted, and that seems to be worrying some people.
So would it have a particular impact on the many New Zealanders who are developing new software?
They will have to watch out for this. The question they'll need to be asking, and one of the experts that I was talking to was saying was, if filing a patent is something that you feel like you need to do, you must reassess this, because another law that has come in the States is loser pays. And so it may cost $2 to $5 million US or New Zealand to actually come to the court to actually bring your case forward. And a large corporation like IBM or Apple will just sneeze and give $10 million to bring their case forward. And of course, they've got an army of lawyers and a massive war chest of funds. Yeah. And if they can do this without even breathing, you're likely having to pay upwards of 5 times the amount you even came with. So unless you have a litigation quality patent or a war chest of funds and an army of lawyers, like I said, there's not a lot of point in filing a patent because you may as well just go with trade secrets.
Indeed. Nathan, thanks very much for that.
NBR Radio with the Property Press. It's out now to show you around.
In banking news, the Commerce Commission says ANZ Bank New Zealand, the country's biggest lender, was the most aggressive in pitching interest rate swaps to farmers, over which it subsequently agreed to pay $19 million in compensation. General Counsel Competition Marianne Borrowdale told Parliament's Primary Production Select Committee that of the 3 banks to settle with the regulator, ANZ had the most customers involved and was investigated over both the way it was able to move its margin and the break fees it charged farmers for an early release. While ANZ announced its settlement with the regulator before ASB Bank and Westpac Banking Corp, it only just made its offer to farmers yesterday. The 3 banks' collective settlements totaled $24.2 million. Ms Borrowdale said there were differences in the misleading representations for a start, because ANZ's case was both about the ability to move the margin and about what break fees would be if you wanted to get out early, she said. Westpac's case was just about the margin because their break fee was comparable as between the swap and a fixed-rate loan, and ASB, when it apprehended there was a problem with its margin representation, chose not to move margins for the original term of the loan, so there was a smaller scale of issues there, which is why you see a smaller settlement amount and fewer complaints, she said. Chairman Mark Berry defended the Commission's decision to settle with the lenders in the face of trenchant criticism from Labour Party primary industries spokesman Damien O'Connor, saying the deal ensured the 256 farmers who made complaints were assured of compensation and wouldn't get dragged through the courts for another 3 to 5 years. He defended the regulator's record of taking court action against large corporates, citing cases against the major trading banks in New Zealand, Carter Holt Harvey, Telecom Corp and Qantas Airwaves. Mr Berry said this was a better, quicker and more certain outcome for farmers. Ms Borrowdale said the Commission expected some customers would fail to prove their case at court. Others, the court would probably have reduced their recovery for contributory fault because in some cases there will have been advice taken. If farmers were unhappy with the settlement offer they received, there was a process for them to query that. Mr Berry said several thousand farmers elected to use the interest rate swaps to take out loans worth more than $8 billion, and those customers who complained to the Commission amounted to between 10 and 15% of the total number. Some farmers had made their own settlements with the banks, something Labour's O'Connor said was often under duress and contained confidentiality agreements in doing so. While the Commission couldn't take a case for any farmers who now come forward because its investigation was closed, Berry said he would expect the banks to offer similar compensation to complainants based on the formula used by the regulator. Let's go to the Crane Index. The Crane Index is turning in Auckland's favour. Ryder Levitt Bucknell's Crane Index identifies 29 cranes in Auckland, 23 in Christchurch, 9 in Wellington, 5 in Queenstown, 3 in Tauranga, 2 in Hamilton and 1 in Dunedin. Commercial construction accounts for 54% of the cranes nationwide, with the balance used in residential or civil projects. According to the RLB Crane Index, 43 new cranes have been installed across New Zealand over the past 6 months. These have been predominantly in Auckland and Christchurch, with 13 and 18 respectively. Wellington added 6 new cranes on important projects. Construction work done around the country in 2014 has risen 42% from levels seen in 2012. The rebound is predominantly within the residential sector, increasing by 58%, and non-residential sectors by 21%. In Auckland, 5 new cranes are at St Albans on Dominion Road, Lynn Mall Cinemas in New Lynn, Goodman's Building C in Wynyard Quarter, and the Victoria Street office development. Cranes have been erected at the ATC Theatre site in Wynyard and at residential projects at the Rothsay Bay Apartments, Hobson Street, Summit and Karangahape Road and the Rose Gardens. Cranes are also on construction sites at the University of Auckland Science Centre and the Akua Hotel conversion project, plus the new Fonterra HQ and Cider building office developments.
NBR Radio, Thursday the 7th. I'm John Stewart. I'm joined by Tim Hunter, who's been doing some digging into a Credit Suisse report which reveals the massive investment by Chinese in Australia's residential property market. Tim, can you tell us a bit more about this?
Yeah, sure. Basically, I've got in front of me a report from Credit Suisse, which is dated May the 6th, so that's yesterday. And the interesting thing about the numbers that they've got in this report are that they show this significant scale of Chinese investors buying residential property in Australia, and also that it's growing significantly. So the actual number is 8.7 billion Australian dollars in the 2013 to 14 financial year.
That's a big number, isn't it?
It's a very large number, and it's significantly 60% higher than the number was the previous year. And these figures are based on statistics that they've derived from official numbers. So it's from the Foreign Investment Review Board, the Department of Immigration, and the Australian Bureau of Statistics. Now that's interesting in itself because they've actually got some real numbers to go on, and that contrasts significantly with the New Zealand position, where there is no data effectively on the extent to which foreign investors influence the residential property market here.
Not even from the OIO?
Not even from the OIO. Just over the weekend, on May the 2nd, it was the Australian government announced some greater controls on foreign investment into residential property. Obviously based on the information that they were able to obtain from these stats. So what they're going to do is that the current regime restricts quite substantially the amount that foreign investors can put into the existing housing stock. So they're trying to target foreign investors into developing new properties. So the Australian government announced measures that will increase penalties on investors that flout those rules. So they're clearly trying to make sure that that the Australian economy gets the real benefit of new investment rather than just simply cranking up demand for existing housing. New Zealand has said that they're not sure that there's much of an effect there, but frankly, we really don't have any data to go on. And despite there's obviously a fair bit of anecdotal concern out there about the extent to which foreign investors influence our market.
Well, it's interesting. There was a billboard up for a couple of months, I'd say, in Ponsonby in central Auckland until recently, and it read, "Reach 2 million Chinese property buyers," and gave a website. So you wonder if the Australian trend is not going to be seen here too.
Well, that's right. I mean, you do expect that we're going to see a fair bit of demand from overseas investors, and New Zealand doesn't really have even the kind of controls that Australia has. So if there is interest out there, then it will be coming in. And it would be nice to know, just what influence it does have on us.
Indeed it would. Tim, thanks very much.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
NBR Radio, Thursday the 7th. I'm John Stewart. With me on the line from Wellington is our political editor, Rob Hosking. Now, Rob's been looking at a set of proposals, for want of a better word, which has been released by IRD today, and it concerns the way we tax our banks. Rob, what's all this about?
Well, this is an area which IRD has been looking at this for quite a long time, and basically it relates to how the income of offshore residents, in this case, most of them are banks, are taxed in New Zealand. And the assumption has been that, has always been that there's, and I'm really simplifying here,
Sure.
Income here can be is taxed, but there can be an offset on that tax against, if the company is paying tax somewhere else. And it's all part of, the world's sort of various metrics of double, tax arrangements, etc. And this is done as far as banks go, through what's called the non-resident withholding tax regime, which is, they pay a non-resident withholding tax here, but there are exemptions to that under certain conditions. Now, the money, because not only are our banks owned mostly overseas, but also a lot of the funding comes from overseas. That means that there is a lot of money coming in that is subject to this tax, and also to the exemption under a whole set of different criteria where there are exemptions. And of course, as soon as you get specific exemptions, it's the way of the world. Taxpayers start looking at, okay, how can I sort of push this a little further, or as far as I can? And that seems to have been what's happening. And in the case of banks, because we're talking literally billions of dollars here coming in and going out, that means that the amount that might be being minimised as far as what tax might be paid is quite large. And so the IRD, this is not a sort of sudden, it's certainly nothing like what we used to have with any tax announcements where the Minister of Finance would come out and say, right, as a midnight time bomb, this is happening. There's there's an options paper. This has been to a certain extent flagged because there was the Minister for Revenue, Todd McClay, mentioned it in a speech earlier this year, and there was a paper went to Cabinet actually late last year. As I say, it's highly technical, but it does look as if some of the banks are using, third offshore entities, which technically aren't related to them, to get around whole chunks of this tax. And so that means that, the IRD has been told, two things. One is you've got to tighten up any leakages multinationally, because there is this very large multinational crackdown going on that's been driven by the OECD, but also domestically, because as we know, the government kind of wants to make sure it gets a surplus, and going after the banks is actually not a bad way of doing that.
So would they be looking at increasing the tax take from this particular tax on the banks?
Essentially, yes. It removes an exemption that the banks had, and so on this the non-resident withholding tax, there are exemptions to it. So effectively they're saying they're going to remove the exemptions to the non-resident withholding tax in some cases, in quite a lot of the cases actually. And so what that will mean is that, and the Inland Revenue paper doesn't have any dollar estimates on this. I'm told it is that some sort of back of a spreadsheet calculations have been done, and it is literally billions of dollars in terms. That's not necessarily in terms of tax, but that's in terms of the amount that's being, the quantum of the money that might be taxed. So this could well reap, the New Zealand Tax Authority, or the IRD, quite a lot more money if it is as big as some people are suggesting.
So when do you think we might see something actually happen on this? It's at discussion paper level at the moment.
Yeah, well, it's a set of proposals, options, if you like. They close submissions. They've asked for submissions. They close mid-June. That suggests to me that the government's going to try and get anything in a tax bill, because they are going to have to change the law here, which we introduced. They usually have a tax bill in November. And yeah, probably the next financial year, I suspect, before anything actually happens, unless they decide, governments don't tend to do this these days, but once in a blue moon they're going to just do something in the middle of the night and just say, right, here we go. Given the amounts of money, I wouldn't rule that out in this case.
Rob, many thanks for that.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To our inflation rate. An expert says the low rate of inflation in New Zealand is in part due to a mismatch of ideas between consumers, firms and the Reserve Bank. AUT senior economics lecturer Satin Kumar says that in general people in New Zealand tend to be largely inattentive about what the Reserve Bank is doing. He says new research in which he was involved shows a large percentage of top managers from firms across the country are badly misinformed about macroeconomic information. Most macroeconomic models assume people are well informed about the objectives and policies of the central bank. But Dr. Kumar argues that people don't actually seem to care about the central bank's activity. He says if you ask firms, even the general managers and directors, about inflation or what the Reserve Bank is forecasting for the next 3 months or 12 months, they have no idea. He says some people who participated in the survey thought New Zealand's level of inflation was between 5 and 10%. Mr. Kumar says the issue here is the theoretical models which the Reserve Bank are using assume firms are fully informed about the economic outcomes and the environment. This means if the central bank formulates a policy, for example, introduces a shock like some form of changes in the macro-prudential tools, it means those effects will not be strongly observed in the economy, as the firms and the consumers may not respond to the policy changes. So it's important, he says, for the Reserve Bank, consumers and the firms to be on the same page, because when the bank introduces a policy, it may just be absorbed quickly in the economy. But New Zealand Institute of Economic Research principal economist Curtin Lee says it's a good thing most people don't think about monetary policy on a day-to-day basis. Dr. Lee says if monetary policy is doing a good job, then people don't think about how fast prices are changing. So when I go, he says, and think about buying a car, for example, I don't need to mentally subtract the underlying rate of inflation from the sticker price of the car. We just need to look at the price, and you can see clearly if it's a good deal or not. Dr. Lee says if inflation was really high, people would try and think about ways to actually buy things ahead of when they get paid and think about what's the right kind of increase in wages. To Australia, Chinese investors spent $8.7 billion Australian dollars buying residential property in Australia in the last financial year, according to analysts at Credit Suisse. The investment was 60% higher than a year earlier. In a report dated May 6, Credit Suisse said it estimated the Chinese buying was equivalent to about 15% of new national housing supply. It said we expect wealth creation in China will continue at a solid rate and forecast Chinese buyers will pour in $600 billion into Aussie housing over the next 6 years to 2020. Government policy proposals to limit foreign investment in housing would probably have only a marginal effect, according to Credit Suisse. According to the Australian Bureau of Statistics, house prices in Sydney grew by 12% in the year to December 2014. The weighted average house price inflation in the 8 Australian capitals was 6.8%. A survey by Demographia published in 2015 ranked Sydney and Melbourne in the world's 10 least affordable housing markets, with Sydney ranked third behind Hong Kong and Vancouver. The same survey rated Auckland as only slightly more affordable than Melbourne, with an index rating of 8.2 versus Melbourne's 8.9. Credit Suisse says its analysts, based on figures from the Foreign Investment Review Board, the Australian Department of Immigration and the Australian Bureau of Statistics, was likely to be conservative. It said, still, while we may bemoan the poor quality data in Australia, we believe it's the best in the world. For example, in New Zealand, where Chinese demand for housing is also reputed to be strong, there isn't a body even attempting to record these flows. The New Zealand government has said it does not believe overseas investors are a significant influence on house prices, but it would look at what Australia was doing. In December, Finance Minister Bill English said apparently Australia is looking at putting in some kind of scheme. We're open-minded about whatever gives you more information. I'm sure he said if the Australians are doing it, we can look at what they're doing. We're quite open-minded about that. Banking news, sort of. Another clash between a major bank and victims of online banking fraud has settled, leaving the law unclear. The case between Distribution Control and ANZ is the latest in a series of online banking fraud cases brought by lawyer John Waugh since 2010. Electrical switchboard manufacturer Distribution Control was the victim of about $1 million in online fraud, and its employee Patricia Hurley was convicted for the offending. Distribution Control then went after ANZ, saying its electronic banking systems did not do what ANZ said they would. Although the trial kicked off on Monday in the High Court at Auckland before Justice Matthew Muir, Distribution Control sought a discontinuance later that day. The case had been expected to take about a week. Mr. Waugh has been involved in 4 electronic banking cases since 2010, which have all settled. He's unable to comment while the settlement is finalised. A common feature of the cases is the allegation that because banks do not cross-check the name and number of a payee in electronic transactions, this leaves the process open to fraud by company employees who enter the correct name but a different account number. An ANZ spokesman said in a statement it's pleased with the outcome, which included Distribution Control paying $30,000 towards costs. The spokesman says New Zealand banks work hard to prevent their customers from becoming victims of any kind of financial crime, and cases of staff fraud within businesses are very rare. The spokesman went on, businesses can help themselves reduce the chance of fraud by avoiding giving specific employees sole or unfettered authority to manage business accounts and payments without recourse to internal checks or audit functions.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
NBR Radio. It's Thursday the 7th. I'm John Stewart, and I'm joined by Campbell Gibson and Nick Grant for our weekly Media Watch. To you first, Nick. The Herald in Auckland is changing editors, by the sound of it, for their weekend editions, the Weekend Herald on Saturday and the Herald on Sunday. Can you tell us a bit more about that?
Yes, John, there's been a slight rearrangement of the deck chairs in the editorial department. It's essentially, there's been the creation of a new title called Editor Weekend Heralds, which means that Mariana Alexander, who has been the Herald on Sunday editor since November 2013, is now going to be also responsible for the Weekend Herald, which obviously comes out on Saturday. So, I mean, there's some obvious logic behind this move. The two products have been, since the launch of the Herald on Sunday a bit over a decade ago, been kind of seen as competitors within the same business. But over the last few years, there's been an effort to ensure a bit more cooperation between the two titles. So I presume Ms. Alexander's appointment is a way of bedding in that cooperation and extending it. Though I guess it comes with the potential downside of perhaps the two titles become a bit samey. They do strike a very different tone. I mean, the Weekend Herald, I think you could argue, is a bit more serious and in-depth. And the Herald on Sunday it takes a rather more tabloid approach to things. So, yeah, it'll be interesting to see if those brands blur a bit and become more similar, and which way it'll go, whether the Herald on Sunday will become a bit more highbrow, if you like, or the Weekend Herald will become a bit more tabloidy.
Indeed. Now, Campbell, there was a big shift of accounts in the advertising industry this week when Spark, formerly Telecom, moved its direct marketing account to Proximity. Why did this happen?
Well, I talked to a Spark spokeswoman this week, and she said that it was, quote, a way of accelerating their data analytics. And reading between the lines...
What's that mean?
Yeah, well, reading between the lines on this one, it means that they're placing a bigger focus on using the extensive amount of customer data that they have to, experiment with new sort of marketing and customer initiatives. And by the sounds of it, their previous agency, RAP, was, just not up to task. And they've been with them for about 8 years, so it was quite a surprising move, I guess, on their part.
And why is this a significant move for the industry as a whole?
Yeah, it's a big one because Spark is, it's one of the biggest advertisers in New Zealand, and it's long been known to be wanting to split from its creative agency, Saatchi & Saatchi, which has been an iconic partnership. It's one of those very old school, golden age of advertising partnerships that's been around for a long time, and they've been wanting to split for them for quite a while. But the two contenders that are, trying to edge for this space, DDB and Colenso. And Colenso owns... You're going to have to bear with me because there's a few agency names that come up here. So Colenso owns Proximity, and it also owns another agency that works with Spark called Touchcast. And meanwhile, DDB owns Dynamo, which is also another agency with Spark. But both of them have a joint partnership in RAP, and that's based in DDB. So naturally, it seemed to be closer to DDB. But anyway, the takeaway from this is that appointing Proximity to be its data agency, Spark sort of made a bit of a statement that Colenso is probably in the front running for its creative advertising account. So
what do you think will happen in the future?
But I'd expect that there's been a lot of industry speculation that Spark's going to have a creative advertising pitch towards the end of the year. But then again, they have said that they're going to be embedding proximity, and big shifts like this take time. So people are picking in the next 3 to 6 months for there to be a Spark creative advertising pitch. But that's been a long time coming.
Now, Nick, at MediaWorks, there's been a shift in ownership. Can you tell us a bit more about that?
That's right, John. Last week, it was revealed that Oaktree Capital had bought out Westpac and Royal Bank of Scotland, two banks that had been left with a shareholding after MediaWorks went into receivership mid-2013. The Oaktree already had a stake in the company, but this buyout has given it a clear majority of 77.83%. Now, there's some questions about what this actually means for the company. The LA-based firm does have experience in media. It's been a shareholder in Nine Network in Australia for some years.
That's more than can be said for some of MediaWorks' previous owners, isn't it?
That's right. And so on the face of it, that's probably a good thing, is that they should have a greater understanding of media and might take a bit more of a medium to long-term approach to their holding. However, I mean, it's very clear that MediaWorks is being prepared for sale, and it's really just a matter of whether Oaktree's majority shareholding is going to mean there's going to be more pressure for a quick trade sale or IPO for the company, less or no change at all. We actually did a poll of NBR subscribers on that last week, and the result was very mixed. 41% actually thought there would be more pressure for to flick on the company. 32% thought there would be less, and 27% thought there'd be no change, which kind of reflects the feeling in the marketplace too, which was kind of a collective as far as the people I spoke to were concerned in any case. There are a few other related MediaWorks tidbits which I thought were worth mentioning. The Paul Henry Show, which screens from 6 a.m. to 9 a.m. mornings on both TV3 and Radio Live, and was launched almost exactly a month ago, has been struggling to make much of an impact in the TV ratings. It's been hovering between about 0.3 and 0.9% in terms of its target TV audience of people aged 25 to 54, which isn't a particularly stellar debut. However, it is worth noting that the real focus of that show is its radio audience. They're really trying to improve the performance of Radio Live. And MediaWorks insists that it's actually doing, they're very pleased with the way it's doing. However, this is based on internal polling that the company has done, and they're not releasing those results, and there are currently no formal public radio ratings in play. I'm not really on top of that, but you're across it, aren't you, Campbell? Can you explain what the story is there?
Yeah, so the radio ratings surveys used to be performed twice yearly, and they were the only way that the industry could judge how well each of the radio stations were doing. And there hasn't been one for quite a while because the contract for the research agency that was doing these biannually surveys expired late last year, and there hasn't been one since. So we've got both NZME and MediaWorks, the two main radio owners in the industry, sort of splitting on what should be happening. So we've got MediaWorks, which is doing its own research as to how a new survey should be done, and that involves things like digital measurement and that sort of thing. But NZME is pushing ahead with its own survey, and they haven't released that yet, but they said that they would release it this month. So we're still sort of waiting for that and what results it'll show. But yeah, at the moment there's no consensus of how it should be done, and a lot of the media buyers are quite frankly annoyed about what's going on with these two media companies, because they want collaboration and just to be able to buy spots in the right radio shows and make sure that their advertising is working, and to have no data that they can work off is pretty frustrating for them. So it'll be interesting to see what the latest survey shows for the Paul Henry Show, because that'll be a bit of a make or break for them.
Well, Nick and Campbell, thanks very much for your insights into the media this week.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
To crowdfunding, Dunedin-based clean tech startup Powerhouse Wind is launching an equity crowdfunding campaign on Pledge Me this afternoon to fund its production of small-scale wind turbines. The company says it has the potential to become the only producer of domestic-scale wind turbines in New Zealand if they can successfully implement their production strategy. The patented Thin Air 102 product, 12 metres tall with a single blade, is a 2-kilowatt wind turbine to use along with solar panels on lifestyle blocks and rural land. The initial working prototype has been in operation and tested since 2008, with 12 field trials completed and turbines involved sold to customers. Powerhouse Wind founders Bill Curry, Wayne O'Hara, Richard Butler and Peter Shaw are former product developers and engineers at Fisher & Paykel. They envisage their turbine will become a common energy-generating appliance similar to other domestic appliances or home heating systems, and say they've engineered the turbine to perform reliably and quietly even in high wind. The company is seeking a minimum $400,000 or 14% of the company, up to $900,000 for 27% of the company. The minimum investment is $1,154 at $5.77 a share, valuing the company at $2.4 million. The board says it came to this valuation through adding together the amount of initial investment, a $360,000 Callaghan Innovation Grant from 2012, and research and development value. The company expects to lose $107,738 after tax in the next financial year on $250 worth of sales. But the board says investors may get a dividend from March 2019, when it first expects to break even, with a almost $250,000 after-tax profit expected in the 2018 financial year on sales of $2.17 million. By 2021, it's forecasting profit of just under $1 million on sales of $6.52 million. If forecast volumes are achieved by then, the board will consider an IPO or trade sale. The company will use the Pledge Me funding to take on 6 new staff and reach the next step of commercial production of up to 200 units per year. In market news, an unusual censure handed down to big sharebroker First New Zealand Capital has been met with a shrug by some market players, even as others play up its gravity. First New Zealand was fined $15,000 on Wednesday after the Stock Exchange's Markets Disciplinary Tribunal found it had failed to notify the NZX of a trading error last July, causing a 14% drop in a company's share price. The tribunal refused to name the listed company affected, saying it was not relevant to the disciplinary issue. The tribunal said the firm's attempt to fix the problem itself rather than own up was a matter of serious concern. It went on, the practice of market participants taking matters into their own hands has the potential to impact on market integrity and bring both the market and NZX into disrepute. Market sources said First New Zealand was a major broker responsible for about 30% of market trades, which may have tempted it to seek a solution in-house. To be honest, the source said, it's an occupational hazard that goes with the territory. It's a mountain out of a molehill. The only thing you could critique them on was not having constraints in place. Another said it was much ado about nothing, just a simple error that can occur in a busy market. According to the censure, First New Zealand received an order from a client to sell stock at market through its direct market access automated facility, a system allowing institutional clients to place trades straight into the market. The order was rejected by the DMA because it was set to prevent trades that would cause a price movement of more than 3%, so it went to the firm's trading desk where it was mistakenly put to the market in full. The error led to trades that pushed the stock's price from $3.13 to $2.70, whereupon First New Zealand placed buy orders to restore the stock price. Although accepting that mistakes can occur, the tribunal said it was very concerned that First New Zealand did not tell NZX about it. It said FNZ's failure to do so meant that NZX was unable to formulate an appropriate regulatory response. This failure was further aggravated by FNZ's subsequent actions in seeking to restore the market itself. Other market sources took a similar line. One said non-reporting of issues in financial markets is a big thing. If a trader covers up, you have to sack the trader. Another said the censure was understandable. If it's about not reporting a muck-up, I can see why the NZX would be quite concerned about that. The size of trades involved, where a sell order for 8,194 shares moved the market, indicates one of the less liquid stocks was involved. One potential candidate is retailer Hallenstein Glasson, whose share price on the day in question closed at $3.12 on volume of 15,050. Hallenstein's company secretary could not immediately be reached for comment.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To the banking sector, Bank of New Zealand, the local unit of National Australia Bank, posted a 4.5% gain in cash earnings as growth in housing and business lending and lower funding costs drove up net interest income. The lender said in a statement, cash earnings from New Zealand banking operations rose to $418 million in the 6 months ended March 31st, from $400 million a year earlier. Net interest income climbed 7.8% to $804 million. Net profit, which includes fair value accounting adjustments and other items, rose 28% to $502 million. The lender's parent reported a first-half cash profit gain of 5.4% to Australian $3.32 billion, although the operating results were overshadowed by its announcement of a $5.5 billion Australian rights issue, allowing National Australia Bank to demerge up to 80% of its Clydesdale Bank unit in the UK, selling the remainder to institutions in an IPO. The bank will put up £1.7 billion to cover potential losses from legacy costs as it exits its troubled UK operations. In New Zealand, average lending volumes rose by 4% in the first half, driven by a 4.7% increase in housing volumes and a 3.5% gain in business lending. BNZ's share of housing and business lending was largely stable, it said. Total interest earnings assets rose by 4.5% to $67 billion. Customer deposits grew by 7.4% to $44.8 billion. The bank's charge for bad and doubtful debts rose to $46 million from $41. Operating expenses increased to $407 from $400 million. BNZ's net interest margin widened by 7 basis points to 2.41%. National Australia's shares last traded at 35.20 Australian and have edged up 3.2% in the past 12 months, about matching the gain in the benchmark S&P ASX 200 index. To those cyber threats, New Zealand organisations are being warned not to give in to cyber extortion threats. The National Cyber Security Centre, or NCSC, a division of the GCSB, has issued an advisory that an extortion campaign is currently targeting New Zealand organisations. Several organisations have received extortion emails threatening a sustained denial of service attack, or a DOS, unless a payment is made to the email sender. To demonstrate that the threat is credible, shortly after receiving the extortion email, the organisations are then hit with a short-duration DOS attack lasting up to an hour. The DOS attack overwhelms a website with connection requests, rendering it inaccessible. NetSafe Chief Executive Martin Cocker told NBR Radio businesses should not pay. Some businesses that have paid ransomware ransoms have successfully recovered their files, but this DOS extortion is much more like an old-fashioned protection racket where you pay to be protected from the people that you're paying. The most likely scenario is that payment will alert the hackers that they are prepared to pay and will increase the chances of them being targeted again. Clifford Clark, the officer in charge of the Police National Cybercrime Centre, agrees. He says they'll only come back for more. Mr Clark says an organisation that receives an extortion email should contact police plus NCSC and its ISP. The police won't recommend one piece of security software or service over another, but Mr Clark does recommend that if your organisation hosts its website on an in-house server, you move it out of your office to a third-party web hosting service. He says that way your core systems won't be affected. Earlier, Mr Cocker noted an upsurge in ransomware attacks on Kiwi businesses. However, the previous wave of attacks were based on so-called crypto lockers. That is, they relied on someone inside an organisation clicking on a malicious email attachment. The attackers could then remotely encrypt a business's files and demand money for them to be unencrypted. The advice there is, again, don't pay. Consider the maliciously encrypted files lost, Mr Cocker says. The best course of action is to assume you'll be hit at some point and to have recent, regularly tested and off-site backups of all your files. Mr Clark wasn't aware of any arrests ever being made in New Zealand over DOS or crypto locker extortion threats. He declined to say if the current wave of DOS extortion threats was being made from any particular country, saying it was a matter of operational intelligence. A spokeswoman for the GCSB declined comment, saying the NCSC did not want any more information in the public arena. Oil and politics. Stroppy voters in Canada have punished that country's longest-standing provincial government because of the slump in oil prices. The Progressive Conservative Party has been running Alberta continuously since 1971, making it the most prosperous province in Canada. Premier Jim Prentice called a snap election to help push through a budget plan to raise income taxes while holding the line on spending to compensate for lost oil revenues. But in an upset, the left-leaning Alberta New Democrat Party took most of the seats in both the business centre of Calgary and the provincial capital of Edmonton. It's pledged to raise corporate taxes and increase oil and gas royalties. Its leader, Rachel Notley, also wants to reduce the province's dependence on fossil fuels. She said we need to start down the road to a diversified and resilient economy. We need finally to end the boom and bust roller coaster that we've been riding on for too long. The NDP, traditionally backed by organised Labour and a third force at the federal level, also opposes a proposed oil pipeline called the Northern Gateway to connect Alberta's oil sands with a planned Pacific Coast terminal in British Columbia. Another surprise factor in the Tories' defeat was the resurgence of the former opposition, the Wildrose Alliance Party, some of whose leaders were wooed last year over to the government. Wildrose regrouped and campaigned against the tax increases and for more cuts in government spending. In New York today, oil futures rose over the US $60 a barrel mark. The global benchmark Brent contract also traded up at $67.70. Oil prices have soared more than 40% since late March as most traders bet the market, which fell 60% through much of last year and the first part of this year, is due to recover.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
Just when is Tax Freedom Day? It's taking longer for taxpayers to meet their annual commitments, but some disagree on when they stop paying the government and start spending their earnings on themselves. Accounting firm Staples Rodway has calculated Tax Freedom Day is today, May 7, but the Taxpayers Union says this is too early as it doesn't take account of local government taxes or rates and the cost of public borrowing. On this calculation, Tax-Free Day is still another 24 days away on March 31st, 4 days earlier than calculated last year. Staples Rodway's calculations carried out for the past 3 years show this year's May 7 date is 2 days later than last year and 4 days later than in 2013. This continues the tradition set by the former New Zealand Business Roundtable, which measured only the central government tax burden. The main calculation was based on the proportion of the economy due to government spending, which all comes from taxation revenues. The health of the economy affects the calculation. In 2009 and 2010, Tax Freedom Day fell on May 4th and 8th respectively. But in 2004, it fell more than 2 weeks earlier on April 16. If local government spending was included in the Roundtable's 2011 calculation, Tax Freedom Day fell on June 10, 1 day earlier than in 2010. In results, Z Energy posted a 10% increase in full-year operating earnings as fuel and refining margins improved and the service station chain sold more fuel. The Wellington-based company said in a statement replacement cost earnings before interest, tax, depreciation and amortisation and fair value adjustments, the company's preferred earnings measure, rose to $241 million in the year ended March 31st from $219 a year earlier. Sales fell 9% to $3.06 billion. Statutory net profit tumbled 93% to $7 million, which Z said was negatively impacted by the 61% drop in the price of crude oil and refined fuels over the financial year. Z says replacement cost EBITDA is the preferred measure for the downstream fuels industry globally. On that basis, earnings fell to $91 million in its first half, missing the company's prospectus forecast of $105 million. For 2016, the company forecasts RC operating EBITDA of $245 to $265 million. The company said the second half of the financial year was a period of recovery and increasing momentum for the company, the opposite of the conditions in the first half. Refining margins improved markedly. Z sold more fuel than in the previous corresponding period, and fuel margins and store sales improved. The underperformance relative to financial targets in the first half of the year, resulting from costs associated with the low refining margins in that half, was reversed in the second half. Z lifted its final dividend to 16.5 cents from 14.3 a year earlier. Shares of the company were unchanged at $5 and have gained 29% in the past 12 months, outpacing an 11% gain for the NZX50. Operating expenses rose 2% to $294 million, with an increase in selling commissions and on-site costs and a decline in employee benefits after restructuring in 2014. The net cash inflow from operating activities was $182 million, more than double 2014's inflow of $81. The company chased volume in its latest year, actively price matching in retail while maintaining average margin. That saw its underlying fuel margin rise 6% in the year at 19.3 cents per litre, while the total volume of fuel sold rose 2% to 2.48 billion litres. Of that, petrol sales fell 1% to 823 million litres, while diesel rose 1% to 861 million litres, with both fuels lagging behind volume growth in the industry as a whole. Other fuels fell 1% to 625 million litres. The biggest gain came from supply sales and exports, which rose 51% to 172 million litres, reflecting 54 million litres of crude and condensate sold to BP through the New Zealand Refining Optimisation Programme. Chief Executive Mike Bennett said, while Z's commitment to match up and compete on discounted prices has meant that up to 40% of its retail fuel volume has been discounted, this reduces margins on total retail volumes. However, tactical pricing has firmed the company's fuel volumes over the second half of the year. To Auckland housing, the Fairway Bay Gulf Harbour property development north of Auckland, a $550 million project that provides work for 500 people, would never have happened without Chinese investment, says a consultant to the development company. Top Harbour, a syndicate of Shanghai Zendai Property, Shanghai Pengxin's Zhan Xiaobai and local firm Westlake Investment, bought Jamie Peters Gulf Harbour development out of receivership in August 2012 for $35 million, transforming it into an 8-year, $550 million project that's created more than 130 house sites and plans to double that within 12 months. Top Harbour project consultant Michael Webb Spate said, "When we started this 2 years ago, there was nobody in New Zealand who could do it. I know because I went around and asked everybody if they wanted to. These guys have come in, stuck their money in, and we've probably got 500 people working over on the site in various ways. Consultants, builders, digger drivers, and what have you. And they're all living in New Zealand and all Kiwis, and they all pay tax." Well, how good is that? The Top Harbour development is cash funded, although it has recently taken on some development finance at a very low loan-to-value ratio from lender ASB Bank. Auckland's housing market has posed a number of problems for policymakers who are struggling to facilitate a rapid building program while demand continues to accelerate. The Reserve Bank has estimated Auckland has a shortfall of between 15 and 20,000 properties to meet population growth, and new consents are running behind the 10,000 needed to keep up at an annual 7,500. Chinese investors are sometimes cited as helping to drive up prices. Webb Spate said the makeup of the Top Harbour Group is about to change after state-owned China Orient Asset Management announced plans to buy 50% of Hong Kong exchange-listed Shanghai Zendai, which plans to sell its stake in the New Zealand developer to another unnamed Chinese investor. The ownership change won't impact Gulf Harbour, he said. The development is through 3 stages, with 132 lots completed with different price points. Of the first stage, 50 of the 65 completed lots have been sold, with most in the 700,000 to 800,000 price range. The second stage has 28 lots priced between 1 and 2 mil, while the third stage has just been completed with 39 lots priced between 6 and 650,000. 10 houses have been built, another 15 are under construction, and more than 30 are under design or waiting for consent. Mr Webb Spate said the biggest hold-up for construction was the lack of resource, with local housing companies building more than 100 houses a year, more than twice what they were doing 3 years ago. While a rising population swelled by inbound net migration was fueling demand, Mr Webb Spate said banks' lending policies were keeping the market running hot. He said while banks are happy to lend money to people, then the market will continue. It's fed naturally by this immigration scenario. That's great, it creates demand, but the bank lending policy is the whole key. Once the next housing stage is completed, the development will look at working on an apartment area in the middle of the area. The development plans to create 1,000 lots, though Mr Webb Spate says that it's a dynamic number and could change as the project continues.
NBR Radio. Free to air online with business news you can use.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Weak dairy prices may affect Treasury forecast. Mixed news for Z Energy as it updates its earnings. BNZ first quarter earnings are up. If you're threatened with cyber extortion, what should you do? How much did the Chinese spend buying houses in Australia last year? And just when is Tax Freedom Day? To find out more on those stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the telecommunications industry, the independent non-profit Internet NZ is backing a new website created by Spark to push its barrow over wholesale copper line pricing. The site, www.becounted.org.nz, reiterates Spark's argument that wholesale copper broadband charges are nearly 60% higher in New Zealand than comparable countries, and that the Commerce Commission should not be increasing them. Internet New Zealand Chief Executive Jordan Carter says there are some important questions being raised by Spark, and the Commerce Commission needs to set out why it wants to set regulated prices in New Zealand that are so much higher than overseas. He says New Zealanders have been enjoying lower prices for better plans for a number of years. This regulatory process risks bucking that trend and pushing prices back up. He says if the Commerce Commission wants to take that approach, it needs to make a clear and compelling case why New Zealanders should pay more. At every stage of its regulatory process so far, it's been pushing prices up in a way that isn't supported by the evidence shared in submissions. Mr Carter says the internet is such an important piece of New Zealand's infrastructure that it's vital Kiwis are not paying too much for it. Any price increase that Chorus is able to take, it will take, and any increase it charges to retailers will no doubt be passed on to Kiwis. Mr Carter says we've said from the beginning that this process needs to be taken slowly so that we've got it absolutely right. This despite calls from the Shareholders Association and others with a vested interest to rush it. Chorus argues the regulatory process dictates that the final pricing principles process now underway should be based on the cost of replacing its network, not overseas benchmarks. Chorus also argues that regardless, New Zealand's comparatively thin and scattered population makes it unique. A draft Commerce Commission proposal released in December wants Chorus's wholesale pricing on a typical home line set up to be cut from $44.98 to $38.98. Retail ISPs were up in arms over the $6.59 cut. They'd been expecting the regulator to confirm the larger $10.54 cut to $34.44, flagged in its earlier initial pricing principles process. And many, including market leader Spark, had already baked the full $10 cut into their retail pricing and market guidance. The draft price represents an EBITDA hit of around $80 million a year for Chorus. The company says it will look at resuming dividends if the Commission's final pricing determination goes in its favour. There are several rounds of drafts and cross-submissions to go before the final decision later this year. To the Australian budget now. A recent string of poor economic data may force the Australian Abbott-led government to introduce regulatory reform. PwC Economics Director Chris Money says that as a result of softer economic data out of Australia, the government's fiscal position is going to take a blow. A few months ago, he says, the Australian government went through an extensive value-for-money exercise where it looked at making some drastic cuts in areas such as social services. It was forced to back down after a public backlash, but Mr Money says he expects the government to have another crack. He says, using its overall budget position as a catalyst, I would expect the government to push through more changes in that area because it's been unsuccessful in coming up with a program it can implement. Mr Money says the inflexible nature of the highly regulated institutions and the labour market needs to be addressed. He says the Port of Auckland, which has a high degree of union involvement, is far more productive than a lot of the Australian ports, and that's around the flexibility of the labour market. The Australian government is also poised to make some changes to its tax system. Changes to the taxation of digitalised products are on the cards for the Aussie government, according to Staples Rodway Taxation Services Director Andrew Dickerson. This means Australians could soon be paying GST on offshore streaming and downloading services such as Netflix, iTunes and ebooks. He says this will create a path for New Zealand's government to implement similar changes. He says, I think it would be unusual for the Australians to be taxing that kind of product and New Zealand not to follow suit. But he says aside from this, it's going to be quite a boring budget from a tax perspective. To Treasury forecasts, Treasury may have to pull back its forecast for New Zealand's economy as prices for whole milk powder, the nation's key commodity export, lag behind expectations. In its half-year economic and fiscal update published in December, Treasury said its forecasts were based on a 25% recovery in dairy prices by the start of 2016. Although it said the risks were tilted towards a slower recovery. In its monthly economic indicators published this week, Treasury said prices so far are in line with its December forecast, but further increases are needed to achieve the recovery in dairy export prices that we forecast in the second half of this year. It will update its latest economic forecast as part of the budget on May 21. Prices for whole milk powder dropped an average 1.8% to US $2,386 a tonne in this week's GDT auction, extending its decline over the past 5 auctions to 27%. Fonterra last week cut its forecast payouts to farmers for the 2014-15 season to $4.50 per kilogram of milk solids, and analysts have pulled back their expectations for next season's payout. July whole milk powder futures on the NZX last changed hands at $2,420 a tonne, while December futures last traded at $2,700 per tonne. Mike McIntyre, head of derivatives at First New Zealand Capital, said Treasury wouldn't have factored in their equations a lower for longer price. At this stage, prices have been lower internationally than what the whole market expected, and unless we have a dramatic recovery in the next couple of months, then there may have to be some sort of revision. Whole milk powder prices spiked higher earlier this year on concern drought conditions may crimp milk production, but they quickly fell away again when that turned out to not be the case. Fonterra now expects production this season to lift 1.5% from last season, from a previous forecast that it could fall 3.3%. Dairy products are New Zealand's largest commodity export group, and the dairy sector generates more than 7% of the country's GDP. The Bank of New Zealand estimates Fonterra's forecast for the current season is below the cost of production for many farmers and expects dairy sector revenue for the current season will shrink by about $6.7 billion. Finance Minister Bill English warned in his pre-budget speech this month that achieving a budget surplus next year is becoming more difficult. He said the budget would forecast a slightly bigger deficit than the $570 million previously expected in the year through June and a smaller surplus for the 2015-16 year.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
In court news, 2 people have been found guilty for their part in a magazine advertising scam which attempted to obtain more than $1 million from about 1,000 victims, but no convictions have been entered yet. Nolene K. Banton, 61, and Johannes Hendrik Maria Middeldorp, 63, appeared in the High Court at Wellington today for delivery of an oral judgment following a 7-week trial which began in February. Both defendants faced charges of dishonestly reproducing documents or dishonestly using documents with intent to deceive, which they both denied. Justice Gillian Mellon, however, found the pair guilty of 7 of these charges, although she acquitted them of 2. They will appear for sentencing on June 12, at which point convictions will be entered. Banton and Middeldorp were 2 of 6 arrests following a joint enforcement agency operation established in May 2012, led by the Serious Fraud Office. The investigation involving 7 different agencies and 67 staff was labelled Operation Edit. The SFO says the scam involved grossly misrepresenting the number of magazine advertisements from prospective clients would be printed and distributed in. To encourage the advertisers to buy in, the magazines were tilted in a way that suggested support of worthwhile causes such as road safety, parenting or family support. Overall, it attempted to obtain more than $1 million from about 1,000 victims. In February, Anthony John Hendon, who the SFO says led the scam, pled guilty to 24 charges of reproducing documents with intent to cause loss. The crime carries a maximum 10-year prison sentence for which he awaits sentencing. 2 other defendants were sentenced to home detention and community work respectively after pleading guilty.
NBR Radio. It's Thursday the 7th. I'm John Stewart. Now, reporter Jenny Ruth is with me and she's been having a look at the results for Briscoe Group. What are the figures showing us there?
Well, Briscoe's sales for the first quarter were up a bit less than 1%, and the momentum's been slowing for several quarters now, so you might have thought that maybe Briscoe's is catching the same melody that's been hurting other retailers. However, the company's managing director and major shareholder, Rod Jerk, says no. He says, yes, it is a very tough market out there, it's very competitive. However, he puts it all down to the weather. last
weather?
Last year there was a really slow start to summer, and this year winter hasn't arrived yet. And he's really looking forward, not personally, you understand, but for sales reasons, to very cold, nasty weather arriving, because then people will rush out and start buying heaters and duvets and relatively high-priced seasonal winter goods. That just hasn't happened yet. Mr. Duke does make the point that although the sales momentum's been slowing, his profit margins have been increasing. And in his view, that means he's got some dry powder to use. If conditions don't improve, he can always sacrifice a few points of margin and get the sales moving that way.
Now, we're expecting a third quarter sales from the warehouse tomorrow morning. How do you think they'll look?
Short answer's no good.
No.
They may get some sales growth in the half-year point. It's their third quarter. In their half-year, their sales were up nearly 2%. However, the problem for the warehouse is making profits on those sales. Anyone can grow sales if you discount enough. The warehouse's profit in the first half was down nearly 20%. Briscoe's latest annual result showed profit up about 17%. That's a very big difference. The current Chief Executive, Mark Powell, did manage to arrest what had been a 7-year decline in sales for the warehouse at the Red Sheds. That's its flagship chain that we all know. The problem is he hasn't been able to grow the bottom line. He's planning to step down in February next year. It's going to be a very, very tough ask for his successor to try and do better.
Jenny, many thanks.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.